The 20 craziest investing facts ever. Just came across this the other day from Michael Batnick, who writes with Ritholtz Wealth Management. Not the biggest fans of the guys over at Ritholtz. I find that at the end of December, he let his politics shine. I got no problem letting your politics shine. I mean, my politics shine. But if you're going to be political, just own up to it, man. Just stop trying to pretend like you're not political and then turn around and turns out you are political. Just own up to it. So I don't like that stuff. But anyway, so this guy right here is a CFA research director for Ritholtz Wealth Management. This is a pretty interesting article. The 20 craziest investing facts ever. Since 1916, the Dow has made new all-time highs less than 5% of all days. But over that time, it's up 25,000%. Thus, 95% of the time, you're underwater. The less you look, the better off you'll be. So you're never as high as what you were before, 95% of the time. Only 5% of the times are you above its record high, but you're still up 25,000%. It's nuts. This one incredible. The Dow has compounded at less than 3 basis points a day since 1970. So 1 basis point is 1/100th of a percent. 3 basis points is 3/100ths of a percent. It's compounded at less than 3 basis points a day since 1970, and yet since then it's up by still 3,000 percentage points. Again, kind of like a doubling of a penny. You ever heard that? Would you rather have $1 million stay or a penny that doubles every day for 28 days, whatever it is? The Dow has only been positive 52% of all days. The average daily return is 0.73% when it's up and 0.76% when it's down. But so think about that. The Dow has been positive 52% of the time. That's it, of all individual days. And yet when it is up, it's up less than when it's down. It's up 0.73% when it's up. It's down 0.76%. Yet it has been up thousands of percentage because those extra 4 times of 100. You got 52 up, 48 down. Those 4 extra times account for all the returns of the market. Thus, it's time in the market, not timing in the market. The Dow has spent more than 40% or more has spent more time. The Dow has spent more time 40% or more below the highs than within 2% of the highs. 20.6% of days versus 18.4% of days. Okay, so I guess it's saying it's been down a lot more relative to the record highs and it's been within spin distance of it. Okay. The Dow gained 38 points in the 1970s. From 66 to 82, the Dow was flat when it's price to price. I mean, factoring dividends, not quite, but it still didn't do much. Why am I using the Dow instead of the S&P 500? They're effectively the same thing. The rolling 1-year correlation since 1970 is 0.95. So the S&P 500 goes up 100, the Dow's 95. So he's saying that's the same thing. I agree. At the low in 2009, U.S. stocks were back to where they were in 1996. That's 13 years. Stocks for the long run, the very long run. Usually, sometimes, exactly. So that took you 13 years and you were back to where they were. I don't know if that's dividends reinvested. My inclination is probably not. At the low of 2009, Japanese stocks were back to where they were in 1980. U.S. 1-month Treasury bills went 68 years with a negative real return. Yep, I completely, and it's going to be the same thing here. I mean, you can't get a positive return. That's just negative real return. They're not even factoring taxes. So that's the thing. You can't be short expecting the interest rates to magically go up and you're going to make all this money. Number 10, at the bottom in 2009, long-term U.S. government bonds outperformed the stock market for about the previous 40 years. That's 100% right. And that's why 2009 and 2009, 1999, 1989, 1979. Yeah, exactly, because we had this huge bull market in bonds, without question, that half it corresponded or coincided with a huge bull market in stocks, but then the stocks fell off a cliff at the beginning of the new century, and the bonds just kept going up, and those days are forever over. Number 11, gold and the Dow are both at 800 in 1980. Today, gold is at $1,300 an ounce, and the Dow is near 26,000. This guy is saying his cash flows are greater than commodities. But I mean, let's fast forward 20 years from now. I don't know, but we don't know that. It might be the next 40 years. Who knows? Over the last 20 years, gold is up 340%. Stocks are up 208% with dividends. Thus, Okay, there it goes, right there. So just prove what I was just thinking about. You can support any argument by changing the start and end dates. There you go. So for the last 40 years, gold has gone from 800 to 1300. The Dow has gone from 800 to 26,000. Thus, gold is better than commodities. But over the last 20 years, gold is up almost twice that of stock. So that's good. Good point there, Michael. Touche, my friend. Since 1980, gold is up by 153%. Inflation is up by 230%. Thus, if you want to say gold is the purest hedge against inflation, well, there you go. It's simply not. But you could say it for other time frames for sure. CTAs gained 14% in 2008 when stocks lost 37%. Since I don't know what CTAs are, so I'm not going to read that. If you had invested from 1960 to 1980 and beaten the market by 5% each year, you would have made less money than you invested in from 1980 to 2000 and underperformed the market by 5% each year. Yeah, I get that, because when you were born is greater than almost anything else. I 100% agree with that. I mean, if you had beaten the market that was minimal from 1960 to 1980, who cares? But if you had been bested by the market when it was roaring, you would have made more money. I get that. But that's a good insight there for sure. The Dow lost 17% in 1929, 34% in 1930, 53% in 1931, and 23% in 1932. Whew. Nuts. Warren Buffett is the greatest investor of all time. In the 20 months leading up to the dot-com peak, Berkshire Hathaway lost 45% of its value. The NASDAQ 100 had gained 225% over the same time. Man, that's crazy. Warren Buffett, in the 20 months leading up to March of 2000, lost 45%. Jeez. Only 47% of stocks generated a lifetime return that matched 1 month treasury bills. Yeah. The reason why so many mutual funds failed to beat the market is because so many stocks failed to beat the market. Only 47% of stocks generated a return of a lifetime return that matched 1 year treasury bills. Again, it just shows you there's a few stocks that tear it up and everything else is just yesterday's news. Dow earnings were cut in half in 1908, and yet the index still gained 46%. The stock market does not equal the economy. And number 20, in 1949, the stock market was trading at 6.8 times earnings and had a 7.5% dividend yield. 50 years later, it reached a high of 30 times earnings and carried just a 1% dividend yield. You can calculate everything and still not know how investors are going to feel. I 100% agree. Anyway, I thought that was pretty interesting. He says, now go talk about it, but I don't see any. Okay, it doesn't look like he was talking about it. But pretty good stuff there. It's a good article. So I hope you find that informative. Pretty interesting there. Lots of tidbits that might get you thinking. I don't know. It might just you might find this informative. All right, we'll see you next time.